All right, let's dive right into this complete due diligence explainer on Pagaya Technologies. We're going to unpack the actual metrics behind their AI-driven financial network. Whether you're already tracking the fintech space closely or you're just looking for a really deep fundamental breakdown, we've pulled together the latest SEC filings, rating agency reports, and market data to give you a true under-the-hood look at exactly what's going on at Pagaya. Here's our roadmap for today. We're covering the company overview, their financial health, valuation metrics, risk factors in ESG, and finally, current market sentiment. Section 1. Company Overview. The AI Infrastructure Moat. So, what exactly does Pagaya do? Fundamentally, they're a B2B2C company delivering the artificial intelligence infrastructure that is literally reshaping the financial ecosystem. They aren't a traditional bank at all. Instead, think of them as this highly advanced tech bridge sitting right between institutional capital on Wall Street and your everyday consumer-facing lenders on Main Street. And their footprint is absolutely massive. They're currently plugged into over 36 lending partners across 5 different markets to facilitate second-look originations. By leveraging this massive network, they've evaluated a jaw-dropping $3.7 trillion in applications. That's trillion with a T. They funded over $40 billion in volume since 2018, and they've done all of this without taking on those heavy, capital-intensive loan acquisition costs you normally see. Operating with this balance sheet light approach means they just earn a steady 4 to 5% net fee on every single loan issued. Section 2. Financial Health, Momentum, and Liquidity. Now, let's look at how that scale translates to dollars and cents, because the upward momentum here is really undeniable. In Q1 of 2026, Pagaya brought in $318 million in revenue, which is up 10% year over year, and they absolutely crushed profitability expectations with $94 million in adjusted EBITDA. That kind of strong performance gave management the green light to actually raise their full-year guidance. Looking ahead to Q2, revenue estimates are sitting right around that $356 million mark, so the growth engine is clearly still humming. Now, consider the number $218 million. Specifically, $218,080,000. That is Pagaya's free cash flow just over the trailing 12 months alone. We aren't just talking about paper profits here. This company is highly cash generative, backed by a fortress of a balance sheet with $1.26 billion in cash and cash equivalents. That gives them an incredible amount of operational flexibility and resilience. Unsurprisingly, the credit markets are paying very close attention to all this cash. Driven by rapidly improving leverage ratios, specifically their debt to EBITDA dropping to 3.5x, Fitch Ratings just revised Pagaya's outlook from stable to positive. But perhaps even more importantly, Pagaya recently secured their first ever AAA rating on a $368 million resecuritization. This is a total game changer. It immediately enhances their liquidity in the secondary market and opens the door to much, much larger pools of institutional capital. Section 3. Valuation. Pricing the growth. So how is the market actually pricing all this growth? Well, Wall Street is definitely banking on a rapid expansion in near-term earnings. While the trailing price-to-earnings ratio is hovering at a modest 15.42, the forward multiple is heavily compressed down to just 5.46. Basically, the market is pricing in some serious profitability expansion over the next few quarters. Looking beyond just the PE, the broader valuation metrics are super compelling. We're seeing an incredibly lean enterprise value to EBITDA ratio of exactly 3.26. When you pair that with a highly efficient 16.26% return on equity, and note that insiders still hold over 15% of the outstanding shares, you get a clear picture of a competitively priced stock. Management's financial interests are very tightly aligned with regular shareholders. Section 4. Risk Factors and ESG. The Reality Check. Impartial due diligence means we absolutely have to look at the bear case too. Fitch points out some very real structural risks here. First off, because Pagaya was founded in 2016, their business model hasn't really been tested through a severe prolonged credit cycle. Also, since they don't hold the loans prior to securitization, they are 100% reliant on the capital markets staying open. If institutional demand suddenly froze up, or if we saw a massive employment shock, their network volume could dry up incredibly fast. And there's a real cost to operating in volatile consumer credit markets. Over the trailing 12 months, Pagaya took $105 million in investment impairments. This was essentially due to weaker than expected credit performance on the consumer loans they actually are required to hold for risk retention. Now, to be fair, $105 million is a massive improvement from the $361 million they lost the year prior. But it's still a structural vulnerability that you have to factor into any valuation models.
On the ESG front, they also carry an elevated relevance score of 4 out of 5 from Fitch, specifically regarding data privacy and customer welfare. Because their AI digs so deeply into consumer finance and collection practices, they are under intense regulatory scrutiny. This isn't just some vanity metric. Institution-level compliance screeners track this closely, and it actively weighs on their overall credit profile. Section 5. Market Sentiment, Wall Street's Verdict.
So how are market participants reacting to this push and pull between strong fundamentals and structural risks? Well, the analyst community is heavily bullish. Out of 11 analysts tracked by Benzinga, we have 7 buys and 1 strong buy. Together, they average out to a price target of roughly $29. Compared to where it's trading now, that implies a massive upside potential of over 70%. Wall Street is totally buying the growth narrative. But wait, because that institutional optimism is completely at odds with how the stock is actually trading. More than 13% of their outstanding shares are sold short right now, which is a very heavy bearish bet. On top of that, the stock has an extreme 5-year beta of 5.34, meaning it moves more than 5 times as aggressively as the broader market. Throw in a recent 1-for-12 reverse stock split and a 52-week price drop of over 46%, and it's crystal clear that the broader market is still deeply divided on Pagaya's future. So let's bring it all together. Pagaya has undeniable growth, a mountain of liquidity, and an expanding AI moat right in the middle of the consumer credit space. But as you weigh the data from this explainer, you really have to decide if you can stomach the wild volatility and their heavy reliance on capital market conditions. Analysts clearly see the massive upside, but the ride is going to be bumpy, for sure. Does this specific blend of high potential reward and sharp volatility actually fit your portfolio's strategy? That, my friends, is the billion-dollar question.